for being a valued subscriber. Today's War Room topic, Got Income. The War Room is a 1-hour webinar that we give every month, a little bit of macro coaching, how to talk about these things in a not fear-mongering way, idea generation, giving you a product update, and definitely updating you on scenarios. Today we'll be presenting new scenarios around first world deflation. Is it a risk on the global scale? We'll give a market update before that, and then go into the alphabet soup known as instruments to generate income. And we'll actually talk about how these strategies work, and is it worth it in terms of balancing risk versus income. First and foremost, a market update. Well, what's been happening? Perhaps the biggest thing, it didn't affect the markets really, but it is going to affect how Americans are. It's really a blast from the past. It's just avoidance of Russia. Let them do what they want. We'll do what we want, and not make that the center of our dinner plate. And that's about it. So, it's big news, kind of going back to this strategy for a Democratic president, anti-war, going into a Cold War area, just to concentrate more on a domestic agenda. That's the biggest thing. Other than that, Russia has still been just a blip for the markets. Big news in the emerging markets, Brazil kind of on its way down, and Nigeria on its way up. We've learned that Nigeria is now the biggest economy in Africa, surpassing South Africa. So that S in BRICS is just, the word BRICN doesn't sound really well, but Nigeria is a bigger economy now than South Africa. Also, with the Brazil side of that coin, big article in The Economist this weekend, and a lot of people were coming in on top of it, pundits, talking about how Brazil's demographics and prosperity are coming to a close. We've definitely seen that in markets and its currency valuation. In terms of Europe, in January we had done a webinar on Europe Renaissance and recovery. Definitely we were early on that, and you've seen that today. Last few weeks, Greek bond sales have restarted, and they've been a success. Even if mild, they have not been a disaster at all. So Europe is having a recovery from its funk, with the worst of the culprits, Greece, also celebrating. And then, of course, big news on our middle class. We've seen income inequality kind of increasing, and with very much related to this deflation topic in the first world. The middle class of the United States is no longer in the top spot. It is our next door neighbor, Canada, probably a mix to do with a smaller population, free health care, and a whole bunch of other things. But our neighbors to the north now have the #1 ranking, the richest middle class in the world.
Right, and just
Good afternoon, Praveen.
Sure, welcome everyone, and just to add to that, it was net after-tax income per capita was what they were measuring when it comes to who has the top middle class, and apparently we've fallen back, although I feel like they don't always adjust those things perfectly for how cheap it is to live in the U.S. Sometimes it doesn't feel that way, but at any rate, Canada, I don't know, they're just the 51st state anyway, right? All right, macro snapshot. A few interesting charts for you with this month's War Room. Starting over on the left side, and actually this kind of is slightly different than what we'll be talking about in a moment in terms of global deflation. But food prices are one of the few areas that are avoiding the deflation trend to an extent. In particular, livestock prices are one that is called out as part of that. As part of the chart there, that's the green line. The UBC is a livestock ETF showing the outperformance there relative to agricultural commodities as a whole. But as we'll see, inflation outside of that one item there is pretty muted. Now, in terms of tech, we talked about the tech bubble in recent months, but we saw over the course of early April that quite a few of the leading tech names actually had hit minus 20% or more, so seemingly entered a correction. They've rallied since then, but remains to be seen if it's just a slight correction and that's the end of that, or if we're going to see a true correction on the broader NASDAQ.
One
Earnings
thing
season under. Go ahead,
on
Russ.
the tech side, you did see some blowout earnings yesterday in Apple and Facebook, I guess, but today we don't have the fruit of that, so that to me is a bearish sign. When if it didn't play out and it was with some big tech rally today, then the opposite tends to happen. So that lackluster result, no matter what the balance sheet says, the lackluster result in the market reaction shows us that maybe that losing steam is going to pick up.
Well, and just to take that point to the broader market, and that's the chart at the top right. It looks like the S&P. Actually, this is an interesting chart. So this is showing the S&P and the S&P PE ratio. So typically they march in lockstep. This is over the last year, showing how as the S&P has been going up and with the fluctuations, that the PE ratio, not surprisingly, would fluctuate with it. So if stocks are more expensive, stock prices are going up, the PE ratio would be higher, right? Well, what's interesting, what happened recently is we saw a bit of a divergence. When the S&P fell just a little bit, because earnings were starting to come out and S&P earnings were looking good, that actually meant that the S&P PE ratio fell faster than the stock market at large. So that's a good thing for equity investors. We see that PEs are actually at some of their lowest levels over the last year, even as the market is higher. So good news there as earnings continue to come out. The last item, bottom right, is just to note that over the last several months, really since the middle of last year, the blue line, that's the home builders index, sort of diverged from new home sales. And new home sales have taken another step down over the last couple of months. They don't seem to be recovering. A lot of the talk had been that, oh, it's just because of all the snowstorms and the tough winter. But the latest numbers out for March, also not particularly good on the new home sales front. So now the question is it the home builders that are too overly excited, or home sales in fact going to snap back? And we'll see which of those is really the stronger of the trends, or is the true trend there. All right, that's the macro snapshot. Let's move now to talk about deflation and the scenarios that drive the need for income. In terms of a review, how did we get here to an environment of deflation or of near deflation in much of the world, and very low inflation in the United States, and zero interest rates? We've had zero interest rates now. Here's the Fed funds rate history. In the top left, we can see, of course, since the crisis till today, we still have essentially 0% rates on a short-term basis. And, of course, that impacts annuity rates, CD rates. We know you guys know that those are close to 0%, but annuity rates as well. Very flat. A slight rise at the end here in late 2013, but if we saw this project out 2014, annuity rates pretty much move with interest rates. You can see that the chart at top right and the chart at bottom left are almost mirror images of each other, not surprisingly. And rates are down in the gutter. So what do we do in this environment? And more broadly, so this is the U.S. and this is where we are with income. What does this mean for the world as a whole?
Well, in terms of deflation, it is a first world phenomenon, not just the U.S., but there are big picture macro factors at play here, and so it's important to mention them. The size of the image tells you which one's the most important. And so, whether it's the United States or Canada or Scandinavia, even these days Brazil and parts of Indonesia, the more populous countries, even parts of India, as we've had upticks in their economy and kind of pulling them into this, away from this developing world status, even those countries have just had dramatic decreases in the birth rates, stabilizing around about 2, just over 2, 2.1, and that means that everybody has 2 babies just replacing themselves. So it's just the replacement rate. And so, while we think of this future of overpopulation and overburdening the earth, maybe there is some saturation point we've reached, and that's just happening. And as the economies get better or people's lives get better, they're just having less babies. But the point is that that is happening everywhere. And so as there's less people, there's less production of stuff, less consumption of stuff, and that just makes sense that you'd have lower GDP. You'd have generally worldwide recessionary items, and so that leads to deflation. So that's exacerbated, of course. I cannot underestimate the how the changing demographics of the first world are what's leading to this, right? The first world baby bust, the baby bust that Harry Dent talks about, it isn't just Americans, right? Of course, after World War II, it wasn't just Americans that came home and got busy. It was it was everybody, even the Axis powers, and so that's a lot of Europe, right? It was a big population bubble, really, and so as that kind of exits the theater, you're starting to see the effects of it. As people get older, they're not consuming as much, and they're obviously not working. So they're in their retirement years not creating. So that's not adding to GDP. Technology automation. We always talk about this automating of jobs, and so there's just not as much being created and not as much being consumed because those people that don't have jobs don't consume as much. And so technology automation. They're also, the other side of the technology coin is it takes less commodities to do things that the technology does, right? And so that drives down technology itself drives down commodities. Because there's being less consumed, there's less commodities going into manufacturing. The whole China story, especially, and so you have commodities sinking. And in terms of our own recession, not every country faced the recession that happened in the United States since 2008, but that sluggish, kind of coming out of that recession has also led to deflation. And this kind of liquidity trap is a worldwide thing where it's not just the United States. We just have our particular bent on it. But I cannot emphasize enough that the demographics we're just not creating as many babies as during the baby boom of post-World War II. Of course, there are the millennials, but which is a similar bubble. But even there, they're not producing as much. They're not driving as many miles. They're not traveling as much because of the way people communicate, etc. So that demographics part is big in driving deflation. In terms of the U.S., you can put together that all those factors are affecting the U.S. Without immigration, we would be the same as Europe, kind of aging populace, not making enough babies to recreate the heydays, right? Japan's already in that place. Europe is getting there, and without immigration, we'd be there. But in terms of our the monetary policy, this whole zero interest rate policy we've had since 2009. We're basically at the max place that monetary policy can go. They can't really do anything more. And the reason they did it was to make sure that people are buying houses, to kind of to stop the housing downturn. But it has had this huge effect on savers, not being able to earn any money on their savings to the tune of, we're going to have $1 trillion in the next year or two. So. One thing we know is that zero interest rate policy is going to outlast quantitative easing. We have confirmation of that. And the thing is, we don't have to guess at what's going to happen as long as we have that. This kind of hope or pipe dream of returning to normalcy, it may just be that hope, because we're seeing Japan, 20 years later, still having QE and recurring QE, presidents or candidates running on the idea of starting QE again in Japan, and they've had zero rates forever. So it hasn't, by forever I mean since 1991, 1992, and getting back to normalcy is not something that's in the cards for them. And again, that demographic piece is underlying all of this. A lot of old people, not enough young people to support them or create more in the economy, right? The graphs there you see on the top right, you're looking at an exacerbating factor for our own deflation here in the U.S., and that is money coming into the dollar. As Japan continues quantitative easing, our dollar gets stronger, their money is worth less. Number two, in the kind of EU crisis, there was money flowing into the dollar. And then now as the S&P's picked up, there's foreign investment that invests in American equities, et cetera, coming back in, and that's dollar-based. And so there's the money inflow into the dollar has been relatively good definitely since mid-2011, as you see there. But over the past 5 years, it's more a dollar strength story than a dollar weakness one, even with quantitative easing. And that leads to a stronger dollar means stuff costs less. It's just the dollar's strong. That's all. In the bottom left, you see there CPI and core CPI kind of against each other, and basically for the past 5 years, we've really had no inflation, deflation, and so or just minuscule inflation. Yeah, very
right.
Mild.
Right, and consistently below the Fed's target of 2%, right? So
exactly, yeah. But that 1% is, I mean, for retirees, especially upper middle class or even middle class folks, the middle class that's left anyway, and they are losing purchasing power. They're feeling the hit of that inflation only because they don't have even 1% to make up for, to at least be flat in terms of their
right. Well, as long as wage growth is not above that point, you're still going to feel it. So.
Right. Yeah. So the benefit of no inflation, they're not feeling that, and it's because there's they're not generating income, the topic of today, on their bank accounts. Okay, so that's the USA in terms of its deflationary picture.
Right. Well, let's talk now. So if that's the picture, that's where we are today, in terms of low interest rates to zero interest rates, and Raj talked about, the factors behind that and the factors behind the lack of inflation worldwide. So all of this sets us up. We've been using the word deflation liberally. I mean, where we are in most of the world today, to be honest, is either a zero or low inflation picture, in terms of the first world. Emerging markets, if we want to talk about the whole world, certainly there are certain countries within the third world, within emerging markets and frontier markets, that do have inflation problems because of local concerns. Most emerging markets aren't near deflation yet, but when we speak in terms of the scenarios we're talking about today, first world, most of the first world is either already in a deflationary environment. Japan has been there, skirting it, or been there for the last 2 decades. Sweden actually tipped into a deflation as of late 2013. And most of the rest of the first world is tottering, or is where the United States is, which is just in a very low inflation environment. So 3 scenarios we see from here: good, bad, and ugly. The good environment would be to have a continuation of this, from a market perspective, meaning an equity market perspective, kind of a Goldilocks environment where we have 0 rates, and so folks have to put their money somewhere. That encourages risk taking, coupled with low inflation. So we're not having any inflationary pressure or issues from a sort of a stagflation perspective. So that's the Goldilocks. Can the Fed keep the bowl warm but not hot? It's not too hot. We don't have the inflation. We just sort of stay where we are for another year or a couple of years, and that would lead to continued rise in equity markets and a nominal drop in unemployment. Growth continues at this sort of pace right where it is. This is the best case scenario for where we are today, where we don't fall into deflation, but we continue right along with the picture where we're at now. That's Goldilocks. So what's bad? Bad would be what if, like Sweden, the rest of the EU tips into deflation, or the balance of Europe does, and the actual EU and currency zone, and they follow Sweden and Japan into that sort of environment. Some of the other advanced economies in Asia might follow suit, thinking about countries like Korea. That sort of a malaise, well, that might tip us into a correction from an equity markets perspective. We'd see yields coming back in. They've certainly risen. They rose during from the record lows in 2011, 2012. But what if they fall back down towards below 2% on the 10-year, and CPI might fall? It's currently at 1.5%, so it's already at low levels as we spoke about. But what if it falls down close to 1%, and we actually see unemployment rise and GDP growth slow some? That's a bad situation with a mild correction on markets on the S&P. Now, of course, then we have the ugly situation, which is what if the entire first world succumbs, including the U.S., we end up with actual negative CPI, so deflation, a true, a major correction on markets, and then the corresponding impacts on unemployment and GDP growth. And it's worth stating that, of course, if the entire first world falls into a deflationary environment, then a global recession is likely close at hand, or we're going to follow on that with the ramifications of that's why you'd see major downside on markets and recession. That leads into, well, those are the scenarios that face us in these kinds of environments, or even if we have the Goldilocks scenario going on, which is maybe it's Goldilocks for equity investors, but how do retirees and other folks, how do many of your clients generate the needed income when you can't get it from the traditional sources? So 4 areas we're going to touch on today. Obviously, this isn't exhaustive. There are other places you can go as well, but we feel like we're hitting quite a few of them in terms of the non-traditional sources, things like MLPs, master limited partnerships, and energy trusts. Most MLPs are in the energy area, energy sector. And then REITs and mortgage REITs, 2 different types of REITs, and we'll talk about those and the differences and the opportunities there. Municipal CEF, so most of you know about municipal bond investing, but we thought we'd cover a specific area, which is closed-end funds that invest in municipal bonds and that use leverage to achieve higher yields there. And then finally, dividend stocks, but specifically a strategy around dividend payers called buy right. Essentially, this is writing call options on dividend stocks to juice the yields and to achieve, in some cases, low double-digit yields with large cap dividend stocks. So let's talk about each of these. We'll start with master limited partnerships, so MLPs, and trusts. Trusts being energy trusts are similar in many ways to MLPs. So first, with master limited partnerships, what we see at the top right there, those are actually results from the HiddenLevers screener. And in fact, if I jump down into HiddenLevers for a moment and I go into the analytics section, we'll see the macro theme library. And I can see if I can pull up the macro themes here. MLPs with 5% yield and mega caps are 2 of the yield-oriented macro themes that we pulled up. So you can go into here and you can hit see all results at any time to pull up results here. So see, these are some of the results that I've pulled into our presentation. I just want to show you how to get here within the tool.
Yeah, for the portfolio managers out there, we definitely need to do a better job of connecting the kind of PM tools to the stress testing. We never built everything in a silo, but as we get our heads around how your workflows are, we don't want to bury that screener or those macro themes. People do like them when they find them, so we're just trying to make sure people know that they exist and how easy it is to get good ideas on managers if you're passive, and if you're tactical, ways to affect your strategy.
Absolutely. And so these are some of the results that we found when we built that MLP screen that I was showing you. So you'll see that the yields, from this chart, easy to get above 7% with quite a few MLPs, some of them ranging up even into the low double digits. As you can see, most of these MLPs or these limited partnerships are in the oil and gas space, whether it be actually drilling for energy, but more often than not, it's distributing energy one way or another, whether in the retail fuel sector or in pipelines, are very popular within the MLP space. As many of you know, you've got to be aware, I didn't say beware, but rather at least be aware of the tax issues with regard to MLPs. It has recently become easier to deal with MLPs that are, held within retirement accounts in terms of how the IRS treats those, but there are tax complexities for taxable accounts, and you should be aware of that. It has gotten easier to invest in MLPs via ETFs and mutual funds, and there are quite a few of those available to take advantage of some of these high yields as well. So that's MLPs. I want to talk as well about energy trusts. What are energy trusts? So these are investments where the public entity that's listed essentially owns a percentage share of royalties that are coming from particular specified oil and gas fields. That's typically the way this is set up. There used to be, there's a previous generation of these that were created in the 80s and 90s and even early 2000s where they were not finite life. Essentially, as long as those fields kept producing, you would keep on getting dividends and a share of the royalties. So I said, so there's really a beware here, and that's what I've circled in red. Some of the newer ones that have been issued in the last couple of years, so like the Sandridge Energy Trust, for instance, or Chesapeake, this Chesapeake fund. And so these, actually, those are the companies that issued these particular trusts. Sandridge and Chesapeake is a well-known name. They issued these new trusts that have a finite life, so they expire after 30 years, or sometimes 20 years, sometimes less in some cases. So, beware of what you're getting into here. Many of these funds, they have eye-popping yields, but look at the 52-week returns. And these are actually total returns. These are total returns including those dividends. So these, on a share price basis, many of these have been absolutely crushed. And in some cases, that's because natural gas, while it has done well of late, had fallen in price overall. And also, some of these funds have had field production problems, things like that. You see fracking has become a big part of the energy industry, and fracked wells, one of the issues is that they tend to produce very fast at first and then slope off very rapidly. So if you're buying shares in existing wells, these aren't companies. You just get a share of existing wells. If those wells slope off in terms of production, well, you're going to get 52-week changes like this. And then even worse, if they have a finite life, you're only getting 20 to 30 years of dividends. If you don't make your money over that time period, well, you're basically out of luck. So there are some bad apples within the energy trust space. At the same time, some of the long life trusts, BPT is a name, the Bruto Bay Trust, has produced great total returns over the years. Some of the others have as well. And so you can find those by searching by industry or by energy sector and looking for high yield within the HiddenLevers screener. So that's MLPs and trusts. Let's talk now about REITs. And Raj, if you want to talk a little bit about some of the diversified REITs, we'll talk about mortgage REITs as well.
Sure. One thing we want to make sure is that you guys are aware that, what is a REIT? There's two kinds of REITs. One big broad category is investing in the actual land or the building, and then the other kind are investing in mortgages, so more like a financial instrument. And so that's very different. You can see there on the left, correlation screener. We break that out as different. When there are different kinds of mortgage investments, REITs aren't the only ones, but if you're going to any REIT that is a mortgage REIT in our system, it will be categorized in that industry grouping. That's very important. Above, you see here the difference between diversified REITs and mortgage REITs. That middle column where yield is at issue, you see on the red, that kind of the thing on the right, that little table, the yield is substantial on these mortgage REITs. It's double digits in a lot of cases, but its S&P beta is usually not as good. In terms of the beta you get to getting that to getting equity type returns. Whereas the diversified REITs on the left, they don't have as much yield necessarily. Some, those are adequate, quite adequate yield, but their S&P beta is usually better. And you're seeing the graph over there below. That is alpha. The blue line there is the S&P 500. And so I just use our screener, the exact same thing that you guys have available to you to find REITs that have high beta to the S&P, and then they actually did better. So that was alpha, and that's since 2010, of course. So you had the blue one, which is Apollo Commercial Real Estate Finance. Not too bad. Even though it's not as good as the S&P over the past 3 years. So the point is you're seeing income from these, and you're seeing yield, and you're seeing capital appreciation. And so it's
right. And to
it's
Raj's
really
point,
nice.
I just wanted to show, just to show quickly within the screener, how would you find these? In terms of taking a screen and looking for these REITs. So generally speaking, within the screener, to find things by yield, we search for those investments that are positively correlated with the S&P 500. We set it to all results. We don't screen anything out. And then we just click REITs over here in asset types. If you wanted to get more specific and look for those mortgage REITs, you would then go in industry under financials, and you would look for mortgage investments. And so that would really pin you into finding some of those mortgage REITs with some of the really high yields that we talked about. Actually, there we go. That should find some of those. But if we wanted to look generally at all REITs, we could take the screen off of industry and then find a broader type, whether retail or all different kinds of real estate investment trusts. So that's how you'd use the screener to find those. And to Raj's point, yeah, so a lot of the mortgage REITs do have eye-popping yields, but as we'll see in our analysis of whether or not various income strategies work, in some cases, it's buyer beware. You're getting a lot of yield, but they're really much more bond-like investments than traditional REITs, which invest in office properties or retail properties or other multifamily, et cetera. In terms of tax-free investments, I wanted to cover a niche within the income space, which are not traditional municipal bond funds, but rather municipal bond funds that are structured as closed-end funds. So muni bond CEFs. And we actually went to a site called cefconnect.com because they have a good screening tool here. One question we'd love follow-up feedback from those of you on the call today on is, are you interested in us adding to our screener the capability to screen by taxable versus non-taxable, so to subdivide different investments by whether they are tax-free. Well, what these closed-end funds, so let us know about that. Now, in terms of these closed-end funds that we're looking at here on this screen, what they do is they actually use leverage. So in some cases lower, in some cases higher, up as high as 50% and more. But they use leverage in order to take traditional municipal bond investments and lever that up and get distribution rates that in many cases exceed 7%. Now, on a tax equivalent basis, if you were taking the example of, let's say, someone who lives in California or New York or high tax state, and in addition to that, they live in a high tax state and they're a high earner, well, the tax equivalent yield of 7% could be up in the 13-14% range. So pretty impressive. But in terms of being aware of risks for closed-end funds, you want to look at the premium or discount. Because these trade like stocks and ETFs, they can actually depart from the net asset value, unlike a mutual fund. And so that's what this little chart is down here, where the orange line is the NAV and the green line is the share price for this particular, for LEO, one specific closed-end fund. And you'll see that, so this was actually 2008 where the price collapsed, but the value of the underlying bonds was much higher. So a good opportunity to buy. So you can watch the premium or discount on these closed-end funds, and you probably don't want to be paying a 21% premium because that's going to correct back to true value over time. Whereas if you can find a fund that is trading at a discount, that might be an opportunity to get in. Because over time they tend to converge again, as you can see in this chart. So if you are looking for, in a client's taxable account for high tax equivalent yields, these closed-end funds certainly offer that. And just be aware of some of the risks in terms of the more leveraged funds. It should be noted that because these are invested in debt, of course, they are going to have that inverse correlation with interest rates.
One thing to note there, that screen was not from HiddenLevers. That was from a specialty site for closed-end funds called CEF Connect. It does look a little like our kind of style and colors, so I just want to make that clear.
Absolutely. All right, we wanted to cover one more income generation strategy before we move to sort of reviewing, over the long term, the performance of some of these strategies, and that would be buying dividend-paying stocks. In this case, we're looking at some mega cap stocks. We created a macro theme called mega caps with yield. But so what if you were to buy some of those stocks, like the General Electrics or the Intels or Chevrons of the world, and then write calls, so sell sell call options against your holdings. So this strategy has become more and more popular, and I know for a fact that some of our advisors are doing that, so much so, in fact, that we are adding a feature that we'll be talking about in an upcoming release that enables you to model this a little more effectively within HiddenLevers to model your buy right strategy. But so what kind of results could we achieve? So we actually pulled, this is from earlier today, actually around noon today, we pulled GE and what some of the calls that were just out of the money here. So the July 27th strike and 28th strike. So GE is trading at 26.50. These are just above its current price. And so we look at that and we see that, well, if you were to sell the 27, which is perhaps, what is that, a couple percent above its current price, you would actually get close to 60 cents. And since this is about 3 months out, that means that you could earn about, so doing the math, it's about 8.5% if you were to sell, an option that's about 3 months out. So do that 4 times in a year. If you're able to, then you would generate a little over 8% in income just from the option component. And then when you add in G's underlying yield, you get a total yield of close to 12% on this strategy. And so that shows, why the advisors and many investors have become interested in a strategy like this. You're creating a total of 12% yield. In addition to that, you do get a little bit of appreciation potential. Now, you are giving up most of your appreciation potential because you're selling options that are close to the money, but you get a little bit of appreciation potential. So let's say that GE stock does go up. You would capture essentially a couple percent more in upside before you got assigned, and then you could repeat. Bear in mind that if that happens, you are going to have capital gains issues, and so sometimes this is a strategy that can be executed within a tax-free account like an IRA on behalf of the client, and so that oftentimes is what advisors will do. And so we're looking here, of course, at mega cap stocks. If you were to use riskier investments, then you might be able to generate more yield, but with the associated risk. I should add as well that you can practice the same strategy against many popular ETFs. So if you were interested in being invested in a fund, but taking this strategy, you could do that. And then, of course, there are some funds that replicate this on your behalf, as opposed to you doing it yourself.
Oh, at least they advertise that they do it.
Yeah, exactly. So there are ETFs, there are mutual funds, there are even closed-end funds that practice these strategies, and many of them do, in fact, have yields that are in the high single digits or low double digits as a result of taking the strategy. And
I wonder, Praveen, if we wrote a feature that actually did this for them, I mean, not automatically, but just reminded them to do it. I wonder, maybe we'll put that out in a survey next time. If we built this feature where it just was a wizard to do this, help you do this, would you guys take advantage of it?
Right, would advisors be interested in that?
I mean, we came from the kind of trading floor, so we, took us a second to learn about the hang-ups that you guys deal with, right? Like your investor policy statements and all your what your fiduciary duties are, and sometimes options cuts against that, or you have to list it out. So there's other things, but if people were interested in that feature, we could make that really a nice wizard workflow for you.
Right. Yeah, we've heard from advisors. There are a handful of advisors, that in our HiddenLevers family that currently execute the strategy and had asked for the ability to model it within HiddenLevers, and so that's coming up within our next release, the ability to model this kind of options writing and show the benefits of it, but maybe even taking that a step further and helping you to find the investments.
And I guess the TD Veo, they don't do that even with their whole purchase of Thinkorswim. Nobody does that for you guys, or custodians, or any trading system you have. Let us know.
Yeah,
I guess
absolutely. So
we're getting some yeses over here, so we'll take a look.
So, sure. All right, on to an evaluation of some of these strategies. Do income strategies work? Well, we thought we'd at least cover a couple of the strategies. The strategy that we were just talking about in terms of buy right, it really gets influenced on how you execute it, so it's a little more difficult for us to make broad statements. If you do a good job of it, it can perform quite well, but if you choose your prices and your entry points in a lousy way. So because it has the aspect of being a trading strategy, that's harder to evaluate. But we did take a look at MLPs over time, and then also at one of the specific REIT strategies, the mortgage REITs, and actually at REITs in general. And so we have a review of those here. First, on MLPs, risk versus income over time. We looked at two time frames. One is over a shorter time frame, so just during the bull market, how have MLPs performed relative to the S&P? And then over a longer time frame, a 10-year time frame, which includes, of course, the '08 crash, how have they performed? So over the last 5 years, so the S&P is the dark blue, we see that some of the MLPs have outperformed. FMO is actually a fund. So a fund that is invested in a range of MLPs actually did outperform. And these are all on a total return basis. So on a total return basis, did outperform the S&P. And the green line here is AGG, so that's the aggregate bond fund. And so its performance is going to be, nice and slow and steady. But relative to the S&P, so in terms of generating income, you're seeing that FMO, which is an MLP fund, not only, of course, it outperformed the basic bond strategy, but it significantly outperformed the S&P as well. And then some of the other MLPs of the last 5 years have slightly underperformed, but been very close to keeping pace with the S&P. Now, over the last 10 years, including the crash, we see that the MLPs, from a risk mitigation basis, during the '09 crash, they crashed just like the S&P, unlike the aggregate bond fund, which was very solid during that time frame. But subsequent to that, and over this longer-term time frame, see a lot of outperformance. Essentially, all of the MLPs that we were tracking in these charts. Now, some of the individual MLPs have obviously had specific issues, but if you were invested in an MLP fund or in some of the larger ones, they've done quite well and had overall alpha over the last 10 years.
I'd like to see a chart, maybe you can do this in the other part, where you compare oil to those MLPs, because oil did a face plant at the end of 2008, 2009 too, right?
Absolutely. And so, yeah, so we can, and so these MLPs do have a beta to oil, which you can look, if we look at the risk profile. And how about we do that? If I look at FMO, which was the fund that we were just talking about, so if I put that in with a little magnifying glass, I can look at what its performance is from a risk profile perspective in HiddenLevers, and we do see that it does have some positive beta to oil. Not overly high, it's 0.3. So some of the positive performance of the MLPs is due to the positive performance of oil over time as well, and that's so not just from an income perspective. So that should be noted. All right, looking at the other category that we were going to take a look at, REITs, in terms of income-generating opportunities. This is more interesting. When we look at the really high yield payers, which are the mortgage REITs, they actually act a lot more like bonds, and they, as rates have risen recently, so this is the top right chart I'm looking at first. Again, the S&P is a dark blue, and the aggregate bond fund is in green. But here we're looking at NLY, which is one of the longest-running mortgage REITs. And what it did was that it outperformed during the period of low interest rates of '09, 2010, 2011, 2012, and it really got crushed as rates started to rise, and then very recently as rates have fallen again, it started to catch up. But overall, 10-year performance has been a little bit below the S&P, but above that of vanilla bonds. Meanwhile, we see that RWR, which is a regular, a traditional REIT ETF, I should say, a diversified REIT ETF, much lower yield, so only a 3% yield, but it's had a slightly leveraged performance to the S&P, and we see that in the light blue, up 150% over the decade versus the performance of the S&P, closer to 100%, what with the crash and all. And over the shorter term, over the 5-year during the bull market, we see the same, that traditional REITs, are up 175% or something in that neighborhood. S&P, outperforming the S&P by, maybe 25%, whereas NOI, which is one of the mortgage REITs, has struggled over that same time frame and been much more bond-like in performance. And we can see that in the bottom right. We really analyze that a little more closely. So looking at mortgage rates, which since these are mortgage REITs, that would be the interest rate that they are most closely tied to. You can see over a decade time frame the degree of inversion between mortgage rates and NOI, which is the mortgage REIT in question here. So it's complete inversion. As mortgage rates go up, NOI has suffered. And when they were falling, it was doing really well. So beware, some of these investments, whether it be mortgage REITs, in this case, energy trusts as well, that there are some risks when you go out and you reach for double-digit yields. Not everything is the same, and not everything is a slam dunk. At the same time, when we look at MLPs and traditional REITs, we see a lot, significant outperformance as well.
Okay, it brings us to the main point, which is we hear advisors, investors, especially folks starting to retire, looking for that income, all those savers just keeping money in a bank account or on the sidelines, or jumping into the S&P because there was a 30% up year last year now, and kind of violating what their own investor ethos is. And we just started saying, well, why do people think that income generation is so difficult? What are the reasons? I mean, there must be more systemic reasons, because we were able to find it, and it didn't take that much time. Yeah, we are financial professionals, but we try to build a system that you can be a total idiot and still find it. Not too hard, at least compare things. And so, the reasons there are in the yellow, but of course we know bonds and CDs. People keep going to that, but that's over. That let's just say that's over. So then what? You don't just give up on that stuff. And I guess a lot of the clients that you're having right now, maybe many of you grew up in the 80s and 90s, and those were the bull market, 2 decades of a bull market, and you forget what dividends are altogether. I still run into people, and they've never really known what a total return is. They've only known capital gains and loss. That's it. The idea of short-term thinking definitely is manifest. I mean, that's problematic in so many of the things that ail us as Americans. But short-term thinking and kind of wanting a gain now, wanting to these kind of get-rich-quick ideas. That's why money's been lost in real estate. It's why money's been lost in the stock market, bad land deals, you name it. But the idea of dividend investing is definitely a safer choice, and for the long term and kind of year over year, that turtle that gets there as opposed to the hare that loses. Since we started Hidden Levers, and that is the pervasiveness of marketing. There's just huge marketing budgets for Fidelity, and so I'll tell you guys right now, a company like Fidelity, whatever they might spend, I think $40 million on advertising in a year. And if you were to guess T. Rowe Price, not as big a company, I think it's something like $60 million. And for a company like us, a startup, it would have been really easy to go after that marketing budget, plaster our site with that kind of advertising, and then have a tainted regressions engine and machine for you. But we know that marketing is pervasive, and what are they advertising? They're advertising mutual funds and ETFs. We don't really see that much advertising for income-generating investments and things that are great for you. Okay. So that's just what I'll say. A lot of marketing, and that people eventually succumb to that. And then one of the biggest things is people don't want to do the homework. We all are fiduciaries. We're paid to serve our customer, but if we can outsource the portfolio management, if we can outsource the homework, we do. But really, it just takes a little bit of homework. It doesn't take too much.
Right.
One thing, that tweet you see on the top left, the most difficult environment for generating income in 140 years. I saw that bit of analysis, somebody else trying to corroborate that. There's tons and tons of people that quoted that and passed that on and kind of used that as a shield to defend themselves. But nowhere did I see anybody saying, yes, this is true, based on my independent analysis. It was just people pass that along because maybe it makes their own lives easier. where they,
Right.
they don't, again, they don't have to do the homework. But the picture you see there is from Life of Pi, and just accepting the failure of the bond exodus in the past couple of years, accepting the failure that CDs and bank accounts just aren't going to return like that, especially if we have a Japan type future. Then it's like, well, am I going to die? Am I just going to let that go and just be based on the whims of the roller coaster of the S&P? Or am I going to look deeper? Maybe there are some other income generating investments. We've shown you today there are plenty of them. And so, just accept the failure of those things that you've relied on, and then move to looking at, be hungry for those other things. So the Life of Pi kind of analogy to me here is really important because, it would have been easy for him to give up. He did have to learn a lot of new skills just to survive, and he didn't let that get him down. So that's how he survived, right? So that's the same dilemma. Maybe not a tiger eating you, but it is a dilemma to kind of roll up your sleeves and do some homework on the alphabet soup of income generating investments.
Yeah, and to that point, I mean, we do see it. We see, a lot of advisors who have, used HiddenLevers successfully to find investments and to find some of the things that we've talked about, and to help them to generate income. Maybe I'll pin some of the blame on us in that our screening tools are perhaps not as easy to use, and we are certainly we continue to work to make that easier. In terms of improving things like the macro themes. I'll just mention again that today, of course, we dropped in NLPs with 5% plus yield and mega caps with yield. So we dropped in a couple of themes for you guys to help you find yield. But investing in those parts of the system and doing that part of the job, it isn't as easy perhaps as some of the other things. But it's not that hard either to go in here and to look to find investments that do generate income. So that's really what it takes, since you can't rely on the Fed to have a 5% discount rate and just drop money into a one-year CD anymore, or into an annuity anymore.
Well, to recap some of today's points, first things first, demographics is the main reason I'd say deflation is happening in the first world. You've got more old people, less young people, less people creating stuff. Speaks for itself, So you got Burt Reynolds there, the king of the baby boomer generation, and that's how he looks now on the right. That's the truth. That is not a Madame Tussauds waxed figurine. That's his real face. So, demographics is just destiny. The idea that deflation is happening, it's right under your nose, and in the first world, it's been happening in Japan. It's not like their lives are horrible, but deflation has been happening there for a long time, and just under their nose. Generating income is not impossible. You can do it. We're here to help for sure. Hopefully you've gotten some pointers here. We're always available to our customers by, just pick up the phone or send us an email. We do have a live chat now too. You can use that. And then, there are a lot of lemons out there in the field of income generating investments. And so one easy way to spot the lemons is when it looks too good to be true. It's like, oh, look at this great yield, double-digit yield, and that is, buyer beware for you guys. Caveat emptor on double-digit yields. Anything else, Praveen?
No, I think that that recaps it. We certainly we did pop into HiddenLevers a couple of times in today's forum to show you where some of these, where we got some of the ideas and where you can find things to help you with the deflationary environment and low-income environment of today. Showed you the macro themes. Of course, there are some scenarios that we touched on. I'll show you where the specific scenarios from today's war room are in the scenario library. If you go to the scenario library, we currently place them in global, and we may upgrade them to trending. But for now, under global, you will find global deflation and the three scenarios there in terms of potential for deflationary environment across the first world, just in the EU and Japan, or the Goldilocks positive outcome. So that's the new scenarios from this month. And some other scenarios that you touch on in terms of commodities, in terms of the demographic shift and the demographic issues. You can find those as well.
Okay, let's If you haven't noticed, Hidden Levers is working a lot faster these days than at the beginning of the year. We're very proud to say we weren't affected by Heartbleed at all. And even we don't. If there was some kind of data thing, we don't keep any personally identifiable information. So, double kudos to us. But one thing we noticed was in analyzing whether we were affected was that our performance was getting a little clunky because there's more features and just you need that tune-up. And so definitely from what we've seen, Hidden Levers are working way faster now in terms of screens loading, the screener, the actual stress testing. I hope you are too. And for your other service providers, ask them to do the same thing because they can do that. In terms of risk monitoring, our kind of alpha features have been out there. Hopefully we've gotten a lot of nice feedback on those to improve. Now you can export the results to Excel. Praveen's going to show that here.
Just to show you guys, yeah, we've been obviously moving fast in terms of improvements with risk monitoring. It's still early days, but you can run your risk monitoring again. For instance, if you change the scenarios that you want to see executed, by hitting the change scenarios and choosing a new set of scenarios, you'll want to run it again in order to take advantage of the changes you've made and to see what the new analysis is. And then you can export to Excel at any time. You can grab all the results and see how all of your portfolios, even if you've got hundreds or even thousands, you can export that to Excel and get a giant spreadsheet to dig deeper into.
One thing I'll say about the risk monitoring area, we never thought people would use it for sales, but they are. Their prospect portfolios are in the same system, and so when they come into this, it's a reason to pick up the phone again. So I never thought that the more we create features that are more portfolio management oriented, the more our asset gatherer part of the audience just figures out how to turn that into a sales tool. I love it.
Right. I had a question on risk monitoring at the household level. Great question. In this early release, you can sort by household to see, on a household by household basis. Let's say, here we have a test household that shows some different accounts. You can see it at that level, but we are working on that enhancement so that you'll be able to run aggregate risk and see it. What does it look like at that level? But as of right now, not quite there.
Yeah, and I will make a public call for feedback on the risk monitoring. Don't feel like you have to be nice. Tell us, we want to release our first version while we're still ashamed, because that way we know it's not too late. We're supposed to hack it into shape as both you guys as customers and us listening to our customers. So don't be afraid to write feedback in that feedback area.
Absolutely. Real quick, coming soon in terms of new product features, we do have some major improvements coming out. And actually, this should be available by early next week. Our first cut at annuities support, in terms of being able to support the idea of annuities having their minimum guarantees and the fee structure that annuities have. And so fixed, variable, and equity indexed annuities, we will be releasing that. The idea of supporting advisor fees as in AUM fees, that will be added to account settings. You'll be able to put in, if you do want to be able to show that for compliance reasons, to add your AUM fees and have that netted out within the stress test and within scenario modeling. You'll see that as well.
Especially for prospects, that's more important.
Right. And then in terms of option support, we're going to be adding, we showed today the strategy of writing calls and using that to generate income. Well, in terms of showing that to your clients, we'll be adding support so that if you as of today, of course, you can add an option to a portfolio. If I go in here, for instance, to the my Hidden Levers portfolios, and let's just say I edit one. Well, we've had for some time the ability to enter an option and add that to a portfolio. Maybe the fact that I've sold a call, but we're adding a feature here so that you can repeat that and repeat it, let's say, on a monthly or quarterly or annual basis to show how often you're doing that in order to generate income. And then whenever you run it in scenario modeling, you'll see that incremental income added to the value of that options position and to the overall portfolio. So that gives you a way of demonstrating the value of selling calls.
Now you just need to throw an execute button on there.
Right, and so yeah, if you guys are interested, we'll see if we can take that yet another step. But so those are features that you'll see within the coming week, and we know that many of you work with annuities, so having some initial support for annuities, that'll be available as well.
Are there any questions for us today? Okay, well, as always, my name is Raj. I'm here with Praveen. We are the founders of HiddenLevers. We'd like to say thank you to Steve and Jonas, our colleagues here who help us a lot, and to the rest of the HiddenLevers team. Thank you so much for being customers and sticking with us. We will be at a few trade shows this summer. Do take a look. Do take a look. Okay. Thanks so much, and have a great May.
Great. Thanks, everybody.